I'm hoping you guys are looking forward to this. So let me just start by sharing my screen. So I'll be presenting alone today, but I just want to give credit to Brian and Randy, two other MFE students who have helped me work on this project. I also want to make it clear that I want this to be as interactive as possible. I'll be going through some of the research I did while in the program, but I'm happy to answer any industry discussion questions or anything pertaining to your interest. So to start, before I just hop into deep learning and multi-factor modeling, I kind of want to give a brief overview. And essentially, let's start with what is a multi-factor model. It's essentially, there's various elements or factors, as you want to call it, that have a relationship with asset prices. So we're going to be talking about the size factor, the value factor, some profitability, and investment tolerance. And these factors have a relationship with asset pricing, and it affects how it's priced in models. And starting off with the evolution of it, back in the 1960s, I'm sure you guys have all heard, if you've taken a finance class, about the CAPM, or the capital asset pricing model. And that is essentially just one relationship that says an asset price, take Apple, for example, is going to be based on the beta or its relationship to the market. And this was a very good way to determine its variability and its expectation of its relationship. And it was able to generate about 70%, able to predict about 70% of the relationship. But then later on, there's something called the arbitrage pricing theory. And this was Stephen Ross who came out with it. And by the way, William Sharpe designed the CAPM, won a Nobel Prize for this. And then Stephen Ross came out and said, you can add more than one factor because the CAPM just takes into consideration its market beta. But when you add in multiple factors, you can build upon your multiple linear regression and get more prediction. And when you do that, you will have a strong relationship. And the arbitrage pricing theory was able to predict up to 90% of the variance. And then we have Fama French, which the research is really based off of, that took that arbitrage pricing theory and the CAPM and added size and value. And they also later added on profitability and investment. And were able to determine that this was, as of now, the best way to predict asset prices through a statistical relationship. And some of the use cases, the main one we're going to be focusing on today is just its prediction power in determining asset prices. That's mainly how it's used. However, it's not going to be talked about much in this presentation, but I think some great use cases for it is really focused on portfolio attribution and diversification benefits. So active tilting is a very special thing where a portfolio will shift towards specific factors. So as you see, the distribution is supposed to be pretty consistent in its each factor. However, they do vary over time. If you can tilt a portfolio to allocate more of a respective weight towards a specific value that you want to target, you're able to diversify a lot of the risk in a portfolio. So let me just start off with the objective of the overall project, and it was to improve the asset pricing via stronger prediction power. Now we live in a world of data science when we're able to take this data and kind of code it and manipulate it in a more efficient manner. So we take our asset prices and we predict them through the Fama French regression. We then use that as a baseline against a LSTM neural network, which was able to improve its actual prediction power and just handle larger sets of data. And then we take those predicted expected returns and we kind of optimize them using a Markowitz framework to really maximize the Sharpe ratio. That's what we focus on because we care about the risk-adjusted returns. Yes, we want to see higher expected returns, but not if the volatility is going to be too great, because the end goal is to really have portfolio managers shift their portfolio to account for such risk and to mitigate it. So going on, the breakdown of the portfolio is that there's a strategy oversight that kind of managed 3 different areas that really had to connect them all into one. There's a multiple linear regression, which I focused mostly on as well as strategy oversight. And then we have the LSTM neural network, which Brian was really in charge of and handled all the certain how many layers, how many epochs, and the certain functionality within that. And then we have the portfolio optimization who Randy handled, and there's different ways basing off the efficient frontier, the Markowitz approach, conditional valued risk, mean clustering, and so on. So the first step was to really replicate the Fama French regression. We have the actual databases, but it's good to kind of understand and get a baseline. And some of the data that we needed was access to the WORDS or Wharton Research Data Services. And this is where we accessed our time series information for stock prices and adjusting close on daily prices, as well as the historical accounting information. And those were really used for the mapping and data cleansing to kind of connect the accounting information on a quarterly basis to its time series returns. We also needed to access the Fama French data library later on for its actual portfolio returns. It's really important to focus on that mapping, because if you don't do that correctly, you won't be mapping on a correct timeline. And as you set up this analysis and model, it could have some issues if you don't do it properly. The next is portfolio grouping. So to actually generate these factors, or they're really broken up into quartiles, and then you take its top quartile and you minus its bottom quartile for the most part. And we'll go into a little bit of details about that later. But it's really just the replication results is that we are able to replicate its small minus big factor, just small cap stocks minus large cap stocks, and it's high minus low, which is its discounted valuations versus more expensive or premium valuations. We were able to replicate it with about 99% accuracy, which we were very satisfied with. And to go on, just to give you a kind of understanding of some of these strategies, you look at its market, which we use its MSCI World Index to kind of get a general overview of the market. We looked at size, which was, like I said, small caps minus big caps. You have value, which is more discounted stocks versus more premium stocks. Then you have its profitability, which is taking its operating margins more profitable versus less profitable firms. Then investor tolerance, and investor tolerance really focuses on how aggressive you're going to be investing. So it takes more of a conservative approach in the amount of capital you deploy versus a more aggressive approach. And just if you look at some of these strategies, you see that passive investing in the market is a pretty successful strategy. You can also see that small cap equities have outperformed large cap, and that discounted valuations do not equate to profit returns. And we can talk about that if you want to, because that's a very serious thing in the factor world, because over time, value is always the best approach, where you want to invest in value stocks. But as of lately, at least this is on a 20-year basis, just solely investing in discounted valuated stocks will not generate your profitable returns that you're looking for. And it's a pretty interesting point to make. It's also pretty clear, but investing in profitable firms is a successful strategy. So if you're not really sure on how you want to go about a passive investing mark, you should just look at profitable firms that really have good fundamentals. And then a conservative approach is often better than a more aggressive one. It removes some volatility, and as you can see, its risk-adjusted performance does outperform some of the other strategies. So just some of the basic EDA that we did, we wanted to first look at some of the relationships between different factors as well as its actual returns. And the returns, as you see, we use Apple, Coke, and Google as an example, and we equal weight that portfolio. And then just some of the ones I want to talk about right now. And the whole idea and factor is understanding interpretability. So market and size and profitability and value are a little bit more difficult to interpret its relationship than investor tolerance and value and investor tolerance and profitability. You can assume with investor tolerance and profitability, a more conservative approach will invest in more profitable firms. The same idea with investor tolerance and value. A more conservative approach will invest in more discounted firms. You're taking less of that risk in your investment strategy. It's a little bit more safer. And taking that, you can kind of look at the correlation heat map that we wanted to plot. And essentially, you can just focus on the colors that are bright because those are the ones I highlight. And it kind of corresponds. I'll go back and forth. So the 4 boxes I selected are the 4 shown in the table. It shows that although it's not that high, there is a relationship between the 4. And it's worth noting that those are some of the ones we looked into. Moving on, I know it's a little messy, but this was taken from the analysis that we did, and this is essentially the 5-factor model that we use in its multilinear regression. We're taking that, what is the expected return? The expected return is a combination of each relationship to its respective factor times that portfolio's factor aggregated across it, plus any idiosyncratic risk that we weren't able to account for. And a big issue with the CAPM and Fama French is outperformance tendency. And this has been shown in the 2 images. As you can see, the blue line is what we predict, and the red line is the actual returns. As you see, it's pretty accurate in its trends. However, it doesn't really account that well for the outperformance or underperformance tendency. And that's something that's always been an issue in this multi-factor regression analysis. Moving on, this is where we took both of the returns from the expected returns from the multi-factor regression and the neural network, and we passed it on to Randy, and he really optimized the respective weights. And we use an optimization framework, which really focused on maximizing the Sharpe ratio, because what that is focusing on risk-adjusted returns. and we adjust it based on a risk aversion factor. In this case, we take its predicted covariance matrix between each of the 3 stocks we use in our sample portfolio, making sure we account for its respective weights. And as you see down below, what it did is that it took the neural network and multilinear regression, optimized its weights. And then we also use an example because this is backtesting, we were able to take the actual returns, treat them as expected returns, and determine its optimal weights to see what would have been the ideal portfolio if we could essentially predict the future. What you'll see is that the optimal Sharpe ratio for the neural network did outperform the multilinear regression, just showing that prediction power is important when performing this type of analysis. It's also important to note that this is the optimal Sharpe ratio across the entire 10-month sample that we took in this specific case. And you'll see that actual returns, of course, is the ideal goal to reach. It's almost impossible to reach that because that's taking the actual returns and using it to optimize. If we can go back in time, say, I know exactly how this stock will perform, what will be our certain weight allocation. This is kind of the performance we got to. And it was just really interesting findings to kind of see and optimize it. Again, this is taking the predicted returns from the neural network and the multilinear regression and using it to determine how we want to allocate the weights. We also didn't want to take into account rebalancing or transaction costs, since the idea of factor investing is typically more for a passive investment strategy. So this is not taking into consideration. We have our expected returns per month, but taking all of those, we only want to determine what the optimal weight be at the start of this portfolio and see over the 10 months which one will outperform. So those are overall a presentation, but please reach out if you ever want to talk about actually what's going on in the industry with how active investors are starting to tilt their portfolios to account for some of these factors. I would be happy to discuss them.
Thanks, Jordan.